Hey, good morning. Hello, everybody. It's morning our time. I'm here with Paul Kiker of Kiker Wealth Management. We are back with another Finance University session here. And thank you for all the responses we've been getting. I know people have been enjoying these. Paul, I've been enjoying them. Really starting to look forward to these every week because it's just, I love talking about this stuff because I think it's so important. So thanks for being here. Thanks for taking time out of your, I know, busy day to share with us.
It's my honor, and I've enjoyed this thoroughly, Chris. This is just, I look forward to it every week.
Well, great. So, me too. So, before we begin, the usual disclaimers all apply, which, let's see, would be this one right here. Remember, everybody, what we're doing here is, well, we are sharing information that's educational in nature. Of course, Kiker Wealth Management and Peak Financial Investing, which is another company I own, we have a relationship. And of course, remember, investing involves risks. Any decisions you decide to make, please consult a finance, tax, or legal professional, depending on the circumstance of that. So, with that out of the way, Paul, last week we talked about the carry trade, and we were going to explain that. I noticed that there's a lot of things really seem to be breaking in the markets. I got to tell you, Evie and I are just 48 hours away from getting on a plane. So I'm kind of hoping this can all hang together for another 10 days or so. Can it?
It, I'll be surprised if it doesn't. We get this pullback in August. There's still a lot of bullishness out there. Now, I am surprised that the market sold off this morning after Nvidia just blowing out their earnings last night. My goodness. 101% increase in year-over-year revenue last year. It was just unbelievable. So, but surprisingly, the market sold off. But the tops are a process. We've had this sell-off. There's a lot of people who are anticipating that we're going to run on to all-time highs. And of course, it's possible. I could build the argument for that. So I think we've got a little bit more time. I think it's going to be the September, October timeframe before we start getting into the much hairier period of time. So hopefully you'll get a chance to enjoy your trip, rest, and get recharged just in time to come back for potential fireworks this fall.
Yeah. Yeah, me too. But so I interviewed Michael Gayed. He's a CFA. People might know him from Twitter, but he was the substance of that interview, which I'm holding off on a little bit because August is kind of the doldrums, right? And rightfully so. People should be taking a well-deserved, needed break. Our mental health all depends on it. So typically in my biz, August is our unofficial, holidays, right? Things just taper off. It hasn't been the case. We've been getting a lot of traction back at Peak Prosperity. Things are still kind of unfolding pretty rapidly. The tragic fires in Maui and the gross things that are now emerging around that, including the fact that people who broke the law and ran the barricades survived, and some people who obeyed the law and turned back did not. It's like, who puts up a barricade to prevent people leaving I can't even make sense of it, So there's a lot of nonsensical things, and I think people want to make sense out of the world. And so that's what we're doing here in our conversations too. And it's why I believe in this thing called Finance University. This was in context. I just released an interview that I did yesterday with Victor Minash. I've known him for a long time. He's a real estate investor and really smart guy. And this was a response that Mike Richard gave us. And this is what I'm always aiming for. He said, "Excellent interview. Thanks for this. I learned more in less than an hour about macroeconomics and real estate than I could have thought possible." So
That's
awesome.
what it's all
That's
about.
what we're here. It's what it's all about. It doesn't have to be mysterious and unapproachable, right?
No, our industry is just ridiculous in how complicated they make it. And I think they're scared to death that if people really understood how simple it is, it just takes discipline. It's basic character and integrity, and it's not that complicated. I tell people all the time that my job is to serve people that don't enjoy looking at this themselves and don't enjoy dealing with the money, because if they really enjoy it, they can learn it. And so it's nice to simplify things and help explain it in an understandable manner to the average person.
I agree. And one of the great points that Victor made, because he's a real estate guy. So, I think a lot of, how it is, everything looks like a nail to him because he's got his real estate hammer, but he's not wrong. He's got a lot of macro data. He's very well grounded. He's, got the gray hairs. He's been around the block. He's actually very successful at what he does. But he understands that he's in the value add proposition. And his belief is that we're already in a recession. The data bears that out. It's trade data from China down like 20% on cargo shipments. And the fact it's just sort of the vibe of this whole thing. He said, of course, recessions aren't known about until after the fact. They're declared in retrospect more often than not. And but even with that, he still thinks that our future is one of inflation. And of course, that's where real estate, and he parses that real estate is not an asset class. It's many asset classes, right?
Yes, it is.
Storage containers are different from mobile home parks, are different from Class A real estate in downtown San Francisco, et cetera. So they behave differently. Obviously, he put that nuance in there. But his belief is that inflation is here to stay because he can't see any way around just printing. And then the idea, and this is where your job comes in, why it's so hard, is, hey, Venezuela's stock market went up 600,000% in the last year and a half. Unfortunately, inflation was 2 million%, right? So how do you stay ahead? How do you keep ahead of that? That's the nature of the discussion right now, making sure you have that plan, what your plan is, but then you got to course correct.
Yes.
And I was talking with Ed Butowski, who runs the Chapwood Index that has not been released yet. That'll be coming out while I'm on vacation. And he's adding it up that it's 18% inflation. You know what he does? The Chapwood Index, they take 50 top cities, the same 200 products year after year. They don't do any substitution. They don't swap them. They just add the price up. The big three for him are always rent, insurance, and taxes, particularly local taxes.
Yes.
Those are the big three. It's not milk. It's not hamburger. It's the three that they jiggle with and all that stuff. 18% inflation in 2022 on average across 50 metropolitan areas, right? So question, so when he runs plans for people, and he does that because he does portfolio analysis, he says you have to plan on, when you're doing the retirement plans for people, he uses 7% inflation as an average. When you run it that way, a lot of people's retirement plans fall apart quick, don't they?
They really do. I mean, I typically what I'll do is run a 3.5, because that's what the industry does and has been supposedly over the past 100 years. Mm-hmm. But I point out the fact that that's highly unlikely we're going to be that low going forward. So I'll run a 5.5%. And the reality is 70 to 80% of the people that we run into, a 5.5% inflation rate is absolutely devastating. I mean, their probability of not outliving their money over their life expectancy is in the neighborhood, drops from, down to 50%. If you go to 7.5%, there are very few people that can survive a 7.5% sustained inflation going forward. So kudos to him, because I haven't met another person in the industry that's doing planning that's even talking about 5.5% inflation sustained, much less 7.5. And the reality is it takes a dramatically different investment approach. Why I wish that we had allowed the recessions to take place, allowed the zombie companies that are out there to go ahead and fail, and allow wiser, more prudent individuals to step up and take the reins of power, is because in a deflationary environment, you can be conservative. You just have to make wise decisions to protect your capital. But in an inflationary holocaust and in a high inflationary environment, there is no conservative way to protect your purchasing power. I mean, there is none. And you have to take the traditional investment model and throw it out the window. So if you're an Argentinian citizen, like you were talking about a moment ago, if you're in the stock market, it went up, I can't remember the numbers that you laid out, a dramatic amount, but it was still losing in relation to inflation. So as an Argentinian citizen, you have to take those assets and go international. As a U.S. citizen, you've got to place assets into the things that we need. You've got to consider international countries and their indexes that are there, and specifically try to find those that are not falling as much as the U.S. dollar or strengthening in relation to the U.S. dollar. So, imagine me sitting down with someone who's 80 years old. They've been in retirement for a period of time, running your standard 50% equity, 50% fixed income portfolio, or 60% equity, 40%, that kind of cookie cutter approach that the traditional main, Wall Street firms will give them. And you tell them, hey, you're going to have 75, 80% of your assets international, and 20 or more of your assets in precious metals, and you're going to have to manage your short-term cash dramatically and make changes. I mean, it's something that they can't even comprehend. And when you get a high inflationary environment, if you're 2 steps behind the average person, you're not going to recover. So that's why scenario planning and conversation planning and I'm big when I talk to individuals, we do our planning. All right, this is where we are. Now we need to do scenario planning and stress testing so that we can talk about what we need to do if we get to that 7% inflation and it's sustained. And if it's admitted, right, we know it's there, but if it's admitted at the government level, it's far worse than that. You're going to have to make these changes, and you're probably not going to like it. You're going to have more volatility, but it's the only way to protect your purchasing power.
Well, I think a lot of conclusions fall out from that, as soon as you put that mindset on. First, I was really trying to steer people away from duration problems in bonds because they were yield chasing back in the day. Like, well, I just can't make it on this, so I'm going to buy these muni bonds. They're yielding 4, right? But now they're sitting on those as losses if they have to sell them, because obviously you can get more than that on a 3-month treasury, right? So that happened. The same thing that happened to the banks, right? They got in trouble for the same reason, right? They got forced out into these long duration things, buying 10-year bonds that are now way underwater, right? So I decry the fact that people got forced, companies got forced, everybody got forced. That's what the Fed did. They forced us. You can stop that Janet Yellen kindly grandmother act right now. This was abusive behavior, right?
Yes.
Forcing people to chase yield, right? Which of course was going to have to blow up at some point.
Yes. Well, and the worst part about it is, I think the statistics are still the same. I know about 5 to 7 years ago, and throughout the past 20 years, there are actually more lawsuits against advisors in our industry against bonds than there are stocks, because people inherently don't understand the risks that are associated with bonds. So imagine if you're a salesperson, you have to earn the right to be an advisor in this industry, because when you first start, if you don't have any assets to manage, you're not an advisor. You've got to be a salesperson. So you're starting out, and you've got somebody you respect that tells you, hey, CDs are paying 1%. Government's going to keep interest rates low forever. Go out and sell 4.5% 20-year bonds and recommend these. You're not going to go wrong with that. Well, people love them if they don't understand the risks that are associated with it. And now all of a sudden they're stuck in a 20-year bond at 4% or 2% or 3%, whatever those numbers were, and they're underwater dramatically, and they don't have many other alternatives. Now, if we do have some turmoil in the market, they might get one last opportunity if long-term rates don't break out to the upside to reposition their portfolio and get out of that situation. But we saw what it did to Silicon Valley Bank, and there's a lot of individual investors who made the same decisions themselves because they were too scared of the market. They felt like there was much more safety in these long-term bonds, and they gambled without realizing they were gambling.
Yeah, well, it wasn't just Silicon Valley Bank. We saw the numbers, right?
Yeah.
$700 billion of collective losses. And that was then. I bet it's only higher now because interest rates have nudged higher since that chart was put together. So yeah, the biggest of the big, the insiders, the big boys and girls, they got caught upside down on this whole thing, right?
Well, even Charles Schwab was at the top of some of those lists for a period of time, which was quite surprising to me. They're
coming back in the news, Paul.
Oh, are they? I haven't noticed that recently.
Yeah, I just was reading something. Oh, I'm going to drop it. I forget what it was, but there was just one asset class that they were upside down on to the tune of 130% of capital.
Ooh, that had to have been their treasury positions, long-term treasuries.
Probably, but I let me hold off until I investigate that. I'll see if I can find it. I'll drop it in the comments here. But yes, I was just reading that and caught me because I've been tracking them for quite a while, because that wouldn't be a good one because people ask this other question. So the theme here is trust, right? You can't trust the system. You can't trust that the Fed's doing what's in your best interest. You can't even trust that Charles Schwab is going to manage its own portfolio well enough, because now you have to trust that SIPC is going to be there if you're if you have over 500,000 or up to 500,000. I guess that's the max they cover. So there's a lot. Right. So the trust gets broken, right? And that's ultimately what our money system is. It's a communication of trust within and across distances. I don't have to know you. I can still trust that your 100 and my 100 have some commonality. But when the money system breaks, now we're back to Venezuela. And when that breaks down, that's when you get hyperinflation because the trust is gone. So fundamentally, fiat currency is a trust-backed system, and they're monkeying with our trust, not monkeying with it. They're breaking it.
Yeah, they're breaking, destroying it actually. And while telling us they're trying to save us in the midst of destroying it. And all I can think of is Nassim Taleb, and you know, there's a lot of things with him that I disagree with, but he made the comment. I think he's the one that said they're intellectual yet still idiots, intellectual, overeducated idiots, basically.
IYIs, he calls them.
Yeah, that's right.
Intellectual yet idiot. Yeah.
Well,
I agree with him on that part.
Yeah. So you take the social pressure that's out there and the stress that people are feeling, and you know, as Americans, they bottled all of this up, and we're starting to see that bubble up in the surface of, we're starting to see it bubble up in our society now. So you throw hyperinflation in there and you take hope away, then we've got all kinds of troubles that are coming our way that we have to be prepared for, which is what you do such a great job of you know, pointing out, helping people prepare, helping them mentally be prepared so that they're 2 steps ahead of the average person when the time comes, so that they can be a blessing to the society and those leaders that step up and help point the path to a wise approach and bring us back to integrity and truth, and leaders that serve us, not steal from us.
Yeah, well, that's why we're in, you know, have a relationship here and getting to know each other, because I can detect, you know, you operate with integrity. I operate with integrity. There's a lot of people out there that operate with integrity, but we've been made to feel as if we're either weird or isolated, and we're not. And I think we're actually in the majority, and I'll tell you why. You've heard the song by now, I'm sure, Rich Men North of Richmond.
Oh, is that not a great song? I mean,
is that not a great song? I mean, it's like he carries the emotion, like he carries the feeling of it. And that's the thing, Paul. This isn't an intellectual process. We can talk carry trade and, you know, bond yields. This is a process when your trust is breaking down. It's a belief system. I want to trust. I want to be able to trust. I really do. I don't want to be out here in this place where I have to distrust everything. The FDA, the CDC, the Federal Reserve. I don't want that.
No.
But it's where we're at, you know, and that's right. An emotional process of how quickly can you let go of the shore because the river's pulling you and just move on in this new way. And that's why I think, you know, those people in Venezuela caught in their stock market thinking, well, at least it's going up. You're being ripped, you know, ripped apart by this and destroyed. So what do? You know? And so trust is actually the key word here is when that goes away, we're a social creature. We need to trust each other. We need to have some level of trust. We
should, you know, and it goes back to that song, Try That in a Small Town. When you have relationships with people and there's consequences to your actions, but in today's society, some of those consequences are manipulated through propaganda, and, you know, people aren't called out if you're on the favored side of the path to destruction in our country right now. You know, you're above the law to an extent, and you're protected. You can say what you want to say, and then, you know, they'll scrub your history instead of throwing it out there. It's unsustainable. We don't know when it's going to break, but we're much closer to the breaking point now than I could ever imagine. You know, like the fourth turning, and you know, that's a great explanation of where we are.
Yeah, and then, you know, one of the key features of that is loss of faith in institutions, and it's not just the FDA, the CDC, et cetera. But think about like what it meant that Harvard was saying our staff are exempt, but the students have to be vaccinated, and they can't make any possible logical, rational risk benefit argument for that. They can't.
No.
But they did it anyway.
Yeah.
Aren't these supposed to be our best? Like, what does it mean when the best of the best can't reason their way out of a wet paper bag? I think you're in trouble.
That's right. That's right. That's right. So, it's sad. It's sad. That's where we are. And we have to understand the reality of the situation. Actually, I keep on my screen reality. And the best advice that I ever heard, came across, you know, just struggling with how the rules of the game had changed. I guess, you know, around 2013, the Fed stepped in and intervened. You know, some of the things that you did in 2007 to really sidestep what was coming, you were rewarded for. wisdom brought about good actions. And I was real frustrated with some of the things. I mean, every strategy runs into a period of time where it's going to struggle, because that's why there's no perfect strategy. And that's why the average investor is not successful over the long term, because they don't understand the strengths and weaknesses of the approach that they're taking. So, they let emotions take over, or they let chasing returns. Their brother-in-law's in their ear all the time bragging about how much they're making. And the average person is not honest enough to share the failures that they have. So I was pretty frustrated. It's just one of those periods of time where there was some churning, and I had an individual look at me that was helping us kind of look at our approach, and he said, Paul, he says, I know from how you want the world to be and how you would like it to be, people of honesty and integrity, and you're rewarded for making the right decisions. He says the rules of the game have changed, and you have to accept the rules of the game as they're forced upon you until you're in a position of power. There's enough people in a position of power to bring the rules of the game back to the way they should be. And that was an eye-opening moment for me. I said, okay, let's roll up our sleeves. Let's get to work. We don't like it, but we got to play by the rules of the game as they're forced upon us. And that was the greatest relieving moment that I ever felt. I still have heartbreak for what's taken place, but it makes it easier to make the decisions that you need to make to help people navigate their portfolios wisely with the rules as they're being played, as they're forced upon us.
Well, I just wrote in along this lines, I just wrote something that said, crime pays, and this is why I'm buying silver. Not investment advice, but I'll tell you, like, I see JP Morgan, one of two of their traders just got sentenced to jail finally, right? But this was just for spoofing, right? And I know that spoofing was just this one little thing they could have looked at. This is much larger than that, including the fact that JP Morgan to this day is 25% of the total silver market, which is a concentration that should not exist in a free and fair market. No. So structurally, it's criminal. Now, the good news, though, is that I think that they can't help themselves, and structurally they create opportunities, but you got to be nimble, right? And see when they've misvalued something, because that's the game, that's how the rules are played, it's a rigged game, or because it's a rigged game in service of a narrative, right, that they want to put out. I think that creates opportunities, but I'm a contrarian that way.
And when you know why you're adding precious metals to your portfolio, and you're looking at the long-term picture, and you're doing it in prudent amounts, or you understand that you're doing it in aggressive amounts, and you stay on top of that, when they flush the market so that they can, they have the ability to overwhelm the market with puts and selling short, and they break these support levels, it's important to have some cash available to move in there and take advantage of that. It's not where you don't let frustration of the fact that it's not done what you expect it to do in the short run, because it's clear. It's kind of like when I saw those headlines, I thought, well, all they did was try to relieve the pressure valve for those of us that realize and understand that there's manipulation taking the market. So they're like, here, we'll give you a little bit, and we'll admit just a little bit, so that maybe we can deflect from what's really going on behind the scenes.
Yeah. Now, so they can't help themselves, right? And let me tell you one of my macro conspiracy theories, right? I think that when the Federal Reserve has too much inflation, they don't like it, so they make a call to whoever they call, and these people start selling futures on commodities in order to drive the price down, and maybe even the president, hey, can you flush the SPR, the Strategic Petroleum Reserve, because we want the price of oil down, because that feeds into a lot of things. It would be unfortunate if all of our monetary excesses in the past caught up with us. So just sell off the SPR. Now, okay. Now we go over to the supply side of that story, and we see, because of those depressed prices, coupled with inflation that's higher than advertised, guess what? Rig counts are down, because it's not worth it to try and drill under these circumstances. So now the rig counts are at multi-year lows, approaching decade lows, right? And that just means that future supply isn't going to be there. So these people, they have their reasons, their narratives, their monetary this, they have their tools, they have their rigging stuff, they got their paper games, but the real world still is over here doing what it does. Right?
It sure is.
So we don't have new mines opening up, because it doesn't make sense to try and open a new copper mine at whatever 280, whatever 380, whatever it is right now. It doesn't make sense to open new silver mines. They're not drilling the oil. It's not happening.
Right.
So I think that creates the opportunities, because I can look at that and go, well, There's going to be shortages in the future. I like
That's
that
right.
story.
That's right. And you want to buy before when nobody else is paying attention to it. You want to buy what's not popular from a value investing standpoint. And then when everybody's talking about it, that's the time you want to look to sell or reduce your positions and start taking some profits. You don't know where the top's going to be, but patience and long-term thinking and understanding the approach that you're taking is what helps an investor be successful. And I think it's more important now than it ever has been, because if our leaders and I try to play devil's advocate with myself all the time. And on our investment committee, we'll take different sides of the position and argue, right? Just to see if there's any way we get out of this without severe inflation. And I just don't see it. I was going to bring this up a little bit later, but you've got the BRICS summit that's taking place in South Africa right now.
Right. Yeah.
Yeah. So of course, President Vladimir Putin was unable to attend because of I want to make sure that I get this right. I've got it in
Prigozhin's plane got shot down.
Yeah. What about that? I don't know. I saw that yesterday afternoon and I was like, what does this mean? Right. What's the global impact of that? And I didn't get a lot of time to think about it, but so President Putin didn't get to attend because of the ICC arrest warrant and the Rome Statute, which would require South Africa to arrest him upon landing there. So he sent, I think it was Lavrov that went in his place, but he attended, he spoke to the crowd via video conference. And, he stated in there that he emphasized that de-dollarization is gaining momentum and the dollar's receding global centrality is, quote, objective and irreversible process. Objective and irreversible. And he goes on to talk about, the illegitimate sanctions that are seriously weighing on the international economic situation and the unlawful freezing of sovereign states' assets. And to me, I think the unlawful freezing of sovereign state assets is the straw that broke the camel's back from a global perspective.
Me too.
Because why make the change? Why go and upend the entire banking system and your international trade and relationship, as long as you understand that there is some integrity to the process, right? Jawbone it all you want. We're going to take your assets, speak to your political base. But the moment that you walk outside of that rule of law and start freezing assets, that's you're guilty until proven innocent, which seems to be an attitude that is unfortunately taking hold on one side of the political aisle here in the United States.
And just let me add one point to that, Paul, which is that we didn't just do that with that was February 28th, 2022, when we froze Russia's sovereign assets.
Yes.
But then we also started a campaign of seizing oligarch assets, right? Now, these are just rich people, right? We call them oligarchs when they're Russian, but we call them billionaires when there are people, I guess, but they're the same people, right?
They are.
Literally the same. So we started seizing those, even though these oligarchs, like, how are they responsible for anything? So that showed that, and I don't care where we saw yachts seized in Monaco, Italy, all over the world, right? That proved that private property rights are no longer subject to rules and laws that go back centuries.
Yes.
We just violated that because we wanted to, because they're bad people. They're oligarchs. We just told you they're connected to Putin. We have to punish them. Hold on. Since when do we we have civil asset forfeiture in this country, which is an equivalent process to me, right? It's just gross and indefensibly so, but keep going. Sorry.
Well, the point being, wasn't one of those yachts sold to one of our billionaires for pennies on the dollar, from what I understand? I mean,
probably.
So, yeah. and that's just, it's horrific. The rule of law is so important because there has to be some integrity in the process. And that's what the United States, especially private assets, owning your own assets, is something that we're supposed to stand for. That's what really set us apart compared to the rest of the world. But all I could think about when he was talking about that, so you've got the president of Russia saying this is legitimate and irreversible. In other words, we're so far down this path, there is no going back. And then it brings to mind President Xi's speech to the Gulf Cooperation Council, which is, and from what I understand, I couldn't find the headline this morning, but I read last night they've invited Saudi Arabia, Iran, and several into the BRICS, which is the first time in I can't remember how many years they've invited them in. So they're continuing to expand. But President Xi's speech to the Gulf Cooperation Council in late 2022 where he said that we have to have an alternative to the US dollar within the next 3 to 5 years. So, you know, this is something that's taking place around the world, is continuing to move forward, and is highly inflationary for us as US citizens, you know. I mean, so that's devastating to us. And the question is, are we past the point of no return? And if you listen to what they're saying and you look at what's taking place, we just don't know how fast this replacement's going to take place.
Yeah, let me see if I can pull this up here, because there's something that's been bothering me for a while. And let me see, I have to go to bonds here real quick. Let's go to this one here. Let's take it on a weekly basis. Okay, I'm going to see if I can pull this up real quick, because all right. So you see that this is a 10-year bond, and we're looking at this. This is 2018, I believe, 19, 20, and so on. So we're many years, because I have this set to weekly right now. And you can see, you know, the bond hit a high here right around, you know, with all that money flooding in 2020. And then as we come down here, we are at, look, I'm holding this at the bottom of this range. We're now in danger territory of the US bond, actually. So this is, remember, prices of bonds, you know this, but I'm saying this for our audience. Prices are the inverse of the yields. So as the price goes down, the yield is going up. We're looking at a price chart here. So as this is heading this way and price is selling off, the yield is going up the other direction. We're at a multi-year high now for 10-year bonds, which everything keys, a lot of things key off of that. Mortgages key off of that, you name it, right? Okay. So got that out right when they put the ad on. That's good. I don't want to help their ads out.
Good move.
They're getting aggressive with ads at FinViz, but that's okay. I still love the company. So I'm looking at this. I'm like, well, wait a minute. So in the context of what you're saying, Saudi Arabia and Iran, they actually asked to join. Now they've been invited to join. So that's now a done deal. You have the de-dollarization is going on. What would de-dollarization look like? Well, that would look like people outside of our country selling either dollars or selling the bonds and then selling the dollars. And you would detect that in a rising interest rate.
Correct. That's one of the signs that you would see of the rot that's taking place under the surface. And that's dramatic. You know, I mean, long-term rates are, to start breaking out. And historically, it's not the inversion of the yield curve where short-term rates are higher than long-term rates that the market start entering into trouble. It's once you start seeing a re-steepening of the curve. So that 10-year starting to break out, if that was to jump high enough to get above shorter-term yields, that's going to create an unbelievable amount of chaos in the markets, and something that people are not expecting at this moment in time. And imagine
this is the beach ball hypothesis, right? The beach ball hypothesis. When you can hold a beach ball underwater for a while, but when it busts out, man, it busts out, you know. And so I think the Federal Reserve, I'm going to say this in the true Southern sense, bless its heart, has has suppressed volatility for too long, because it was never a right time for the Joseph Schumpeter, creative destruction fires. So they suppressed brush fires, and now we have a crown fire coming potentially because, they just didn't let it happen because it was never a good time, and they had to be interventionist, and they're anyway,
right.
A pox on them. But
yeah. So the question is, and this can move into the yen carry trade discussion, is at what point, it appears that it's inevitable that our government starts entering into yield curve control, which is it.
Explain that.
So yield curve control is where the government steps in to start buying bonds to artificially hold down interest rates and keeping them below what the actual market rate should be. And that leads to highly inflationary, weakened currency versus everything else. That's something that the Bank of Japan may or may not have to do, depending upon what their long-term interest rates are doing. So you might can explain it better than I, but it's basically artificially manipulating longer-term interest rates by, supply and demand will drive that. If you don't have enough buyers for bonds that are coming to market, I think what the government's got to do $1.8 trillion between now and January 1st. So
Yep.
this would be a, you know, a terrible example, but an example of what yield curve control would be. So let's just say U.S. investors and foreign investors go, no, right? You're spending too much money. So we're going to cut off the line of credit. Well, who's the buyer of last resort? Essentially, you'd have to have the Federal Reserve come in and start buying the government debt issue bonds to create the supply to hold those yields down instead of letting the free market take over. So that's a controlling process.
Well, they did that with Operation Twist, which was a form, but that's sort of a loose control. Yield curve control, as Japan practiced it, is a hard line. These bonds will not rise above 0.5%. If they rise to 0.51, that's when we know we step in to buy. And of course, they did that to the point where there is no Japanese government bond market. I was reading last year, they had whole days where none would trade because there's only one buyer, right? The Japanese central bank, like whole days with your multi-trillion-dollar government bond market where there's not a single trade.
Right.
You know?
Well,
that's weird stuff right there.
It is. And furthermore, how it just came to mind. So I cannot remember the statistic. You might remember it, Chris. But you know, they're buying Japanese stocks they're buying the Nikkei index as well. So they own what, 50 or 60% of the market the Bank of Japan owns. So
that's right.
I wish I could, you know,
Google of the ETFs. I knew they bought the ETFs, but I haven't looked into it lately. But you're right. Yeah, it's just nuts.
I may be completely off on the number because I can't remember exactly what it is. I've not looked at that statistic in a while, but it was a pretty big. I mean, when I heard the number, I was shocked. I'm like, oh my goodness, is that coming to the U.S.? We don't know, but they seem to like what Japan's doing.
Well, so this is important. So we're going to jump now to the carry trade because this is really important because this is where I think there's going to be huge volatility. And by volatility is a euphemism for there's going to be blood in the streets and people are going to be running around with tunnel vision and their hair on fire, which is why you got to have a plan and you got to have a diligent plan and you need to know how you're going to be before that happens because it's really hard to figure stuff out in the chaos of the moment. But let me do this. Let me do this real quick because let's go to the carry trade real quick. All right. So Bank of Japan, let's say they set the benchmark borrowing rate below 0.1%. Money's free. It's as no cost, right? And that's what they did for a long time. So an investor comes in and they borrow this Japanese yen at that super low interest rate. So the carry trade is we're carrying money from a low interest environment to a higher interest environment. That's what carry trade means. We're trading, but we're carrying money from one principality to the next. Okay, so we start in Japan. And we're like, okay, it begins with borrowing. So I borrow $1 billion from some Japanese, financial firm, and they maybe have a couple of basis points markup on that, but that's ultimately what happens. Cool. What's next step? Well, now we got invested somewhere, so maybe we step over to Mexico. Their bonds are yielding 6.5%. Well, cool, okay, because that's what their December 23 bonds are yielding. So that's awesome. So hey, look at that. I borrow at 0.1, and I'm getting 6.5. Dude, if I have $1 billion to invest, I'm going to want to lever that tenfold. I want 10 billion. Give me as much of that action as I can get. Right? Of course, what's my risk? My risk is that maybe the Japanese yen falls compared to the Mexican peso, and now I'm exposed. So I got to hedge this. So I got to do a little currency hedging. So there's all this, there's trillions of dollars wrapped up in these carry trades, and they're all over the place. This is one example, but Japan is a big source of it because that was cheap and it's a highly liquid, big, giant market. Yes. Financial firms, equity funds, private equity, hedge funds, they could all go over there and borrow like crazy and invest in Mexico, New Zealand, you pick, right?
And the Mexican current peso has been increasing dramatically in 2023. So that the profits on that carry trade right there have been unbelievable. And, we think about 5 to 10 times leverage, Chris, but in the carry trade, there's up to 200 times leverage, times leverage that can take place in that market.
So yeah, volatility happens when you have to suddenly undo that whole thing, right? And so that's the whole thing, and that's the carry trade, right? So there's a couple of effects from this. So the country you borrow from, their currency goes down because what had to happen here? I had to borrow this in Japan, but I'm borrowing in yen. Mm-hmm. Now I got to sell the yen because I actually need to sell the yen by the Mexican peso so I can buy a Mexican bond. That's just how it works, right? I got to sell yen buy pesos. So what that means is the currency of the country we're borrowing from, in this case is Japan, goes down, but it goes up because I'm buying the peso, right? So that
Yes.
tends to drive it up. So
Supply.
you have that. Yeah, in the country I invest in, this is easier. I know interest rates go down because I'm putting more buying pressure on the bonds, so the price of them is going up, the interest rate's going down in that country. It may or may not go up or down in the country I'm borrowing from because it depends if I shorted those bonds or not. If I did, or sold, borrowed in bonds and shorted those, interest rates may go up correspondingly. We don't know, right? But it may be that I've just borrowed money from a firm over there, and so this is not a guarantee, but this side is. And then, of course, when we unwind that, other things, the opposites of those things happen. And it could be these things tend to build up slowly over time. Like every year, there's a few tens of billions or more in this trade and all of that. But when they unwind, they tend to go really fast because things turn against you, and suddenly you're a hedge fund and you got some profits, you got to lock them or lose them, and so you just you sell. It can be a little panicky when these carry trades unwind. Now, against that, we have to now note this, which is the Japanese government bonds, and the Bank of Japan is doing everything it can to hold that yield curve control way down here at 0.5%. And it's just blown through there on these 10 years, right? It's just way out of hand at this point in time for them. So I don't know. It feels like things are starting to blow up, and they just had a 20-year JGB auction very recently, and they had a big blowout on this. These were for their September 20. It's an auction for September 12th, 23 settlement, I think. And this was a pretty big, your auctions aren't supposed to fail. Not
That's right.
you want this nice and steady through the auction. This is a pretty big pop. I know it doesn't look like much going down, just a few ticks on price, but it was a pretty big deal. So we're starting to get these rumbling signs that one of the biggest, fattest, most lucrative carry trades is starting to get a little dicey.
Yes. And it happened, slowly and then all at once, to go back to the bankruptcy quote, because once the majority, because this is an unbelievably popular trade, especially with the Mexican peso and emerging market currencies, because that carry trade's been ridiculously profitable. So in a 2-year period of time where it's been hard to find positive returns and higher return assets, then, this is something that people are chasing in desperation. And think about it. What if you're a too big to fail institution, right? We saw the risk that Silicon Valley Bank took with the belief that interest rates are going to stay low forever. Imagine if you're a bank that you feel very protected by, right? Protected by the powers that be because you're too big to fail. What are you going to do? Carry the risk, and get into this? So when people start leaving in mass, they have to get out really quickly. And that yen carry trade was very popular from late 1990s until 2008. I think the return was somewhere in the neighborhood of 40% just on a straight exchange, not add multiples to that if you had 10 times leverage or 400%, just to keep it simple. But now we've got a situation where a lot of the emerging markets, instead of raising rates, are pausing. The US is talking about pausing. So you introduce currency volatility in there, that carry trade changes. But what about those individuals that use the carry trade to invest into the markets, right? So the markets get volatile, that unwinds even more, because you're not limited to just going into the currency and the treasury of another country. If you're aggressive, a gambler, then you're going to use that carry trade to fund your equity market purchases. So it can exacerbate any volatility, and as that car starts to teeter, we swing off the right-hand side of the road and overcorrect to the left, and then you overcorrect to the right, you completely lose control. That's when major accidents can happen.
Yeah. My model for this is the parable of the frog and the scorpion, right? And the frog's at the side of the bank, and the scorpion comes up and says, "Hey, I'd like to cross this river." And the frog says, "No, you'll sting me." He's like, "Dude, why would I do that? I would not sting you. We would both die." He's like, "Oh, good point." So frog agrees, starts carrying the scorpion halfway across, gets stung. As he's blurbling under the water, he says, "Scorpion, why did you do that?" He said, "Well, it's because that's who I am." So
I've never heard that
The,
analogy, Chris. I like that.
yeah. So these bankers, right? They're
Okay.
perfectly willing to be these narrative control machines. The government wants them to short oil or, step on silver and gold so fiat money looks better. They're totally willing to do that. But we saw this at the Lehman moment. The Lehman moment, what was the Lehman moment? That was the moment the banker said, "Oh, I don't know where the risk is," and they all pull back at once. It wasn't because Lehman itself represented such an existential risk necessarily. It was because all of a sudden they didn't know who was holding the bag. And that's one thing Wall Street is geared never to be, is the bag holder. So they all went back and they retreated to the scorpion nature. I trust that when push comes to shove, money protects itself. Period. Full stop.
Absolutely, because
We're just not there with all this funny liquidity floating around. But when you get into a credit crisis or there's a credit event of some kind, that's when you find the true nature of these players, and it happens fast, right? That sting, it comes quick.
well, and one of the things that Wall Street's going to say, your traditional cookie cutter investment market's down 50%. Don't get me wrong, that's not a time to sell. When I had people coming to me that were like, "Hey, we heard you sidestep the market. We'd like to get out at the bottom of 2009." I'm like, no, 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 no. This is not the point that you sell. We're starting to go in. You've got to hang on here and give yourself the greatest likelihood to come back up. But the average investor, when that market turns and it's down 10%, well, it's going to recover. If it gets back to this level, I'll sell. Well, then they're down 20%. Well, if it gets back to 10% down, I'm going to sell. Then they're down 30%. And they repeat this all the way to the bottom until they puke. And that's why market bottoms are events. But these big traders and these big business, these businesses from a corporate standpoint and bankers, they're not going to go, "Well, we're down 10%. We want to wait till we recover." They're down 10%. They reassess the risk of the situation. They go, "We could be down 20 or 30. We're out now." So that's why it unzipped so quickly, because nobody wants to be the last person to get out because you're wiped out.
And it's the amounts involved. I mean, I'm actually thankful to be a small trader because I move nothing when I buy something, right? But, you know, but imagine you're one of these big houses, and you're a Fidelity. There's nothing you can do. You're even like a super wealthy family office. Your tracks are going to be noticed, right? And it's very hard. Like if you had $1 trillion, you had to protect. I don't even know what you would do, right?
Right.
You're not going to move into silver or gold or land in any meaningful or quick way to get any of that protected. So it's tricky.
It takes time, and you're going to have to maneuver. And that's why I'm so distrustful of a lot of the media and the emails that come out. You need to buy this. I have clients comes, "Oh, they're telling me I need to buy this." Now that may be right for a while, but I mean, think about it. If you got $1 billion of something, you can't just exit the market in a hurry. You've got to get out in time. So when you recognize that there's a change taking place in the underlying economy, what do? You pay marketing firms to go out there and create this narrative that's really strong to create the demand for you to get out. And we all inherently know that Wall Street's terrible about selling their assets to the retail investor, at the worst possible time. But that's why market tops are so hard. They're so confusing, because you've got this great narrative. Summer of 2008, the Fed comes out and says, "Everything's under control. We're fine. Subprime's contained." And then you have Lehman Brothers collapse. And there were individuals that got out well before Lehman Brothers. I guess it was just the ones that were not as connected, were left holding the bag. So we don't want to be the person holding the bag.
I have a theory. This is why we didn't have any of these big sell-offs through 2017, 18, 19, through all of that, because the statistics show that the retail investor was still kind of MIA, right? And so my model for that is it was all big players. There was no bag holder, right? It's hedge funds against JP Morgan, and they were caught in this standoff, and there was nobody to sell to. So they had to get the FOMO back. They needed the retail. They need a bag holder. That's the nature of the beast. Trading is a zero-sum game. Your gain is my loss, and that's the game. And most people don't see it that like, "Oh, it's wealth creation." Like what? It just came out of nowhere,
Right.
It doesn't usually, right?
That's
So
right.
there are companies that add wealth and value, and that's true. But for a lot of it, it's particularly when you're at price earnings multiples where we are, it's speculation. And so now it's zero sum for a lot of cases.
Right. For speculation. And a lot of individual investors don't realize the damage that can be done. It's not like all of that money goes to someone else, right? So if you've got a stock that trades at $100, then you've got a market cap that's available there. If there's a vacuum and it trades at $50 next on the next trade, well, the last person that sold at that value got their money, but that's not what everybody got out of it. Everybody lost $50, and you lost that market cap there in the interim period. So it can accelerate quickly. And the retail,
it can, and by the way, the everything that they focus us on, the stock market, right? That cash market, that is literally like this little tiny chump change now. There's a quadrillion dollars of derivatives. That's a zero-sum game.
yeah.
If you're on a derivative contract, somebody wins, somebody loses. There's no value creation there, period. So quadrillion of that. All futures market, zero sum, winner, loser, dead offset, zeros out. Options, winner, loser, zero is out, right? Those are the three big markets I know about.
Yeah. And you see this speculation and the fueled speculation by the Board of Exchange coming out with zero data expiration options, right? I mean, it's pure gambling. And the retail investor, the average retail investor, has discovered what options are. They're giddy about it. You know, it's unbelievable the number of retail investors that are participating in this market and have been doing well for the most part, you know, and helping to fuel these gamma squeezes. Like, I never imagined that I would say gamma squeeze to a client or in a situation like this. You know, and what a gamma squeeze is somebody buys options on a stock, and then the dealer who sells that out there has to cover their risk to the top side so the stock doesn't take off. So it's forced, you know, buying that can take place, and it can happen in the opposite direction. So you would have never imagined that you hear these conversations in the open public with retail investors, but that's where we are now. The speculation's gotten that strong, and there's this unspoken underlying belief by the retail investor. They have convinced themselves that the Federal Reserve is not going to let us blow up. The Federal Reserve is not going to let this happen. But you know, I want to share a screen real quick, going back to the
please do.
Nikkei. Let me get over here real quick. Hopefully this will work the way that it was supposed to. There. So can you see that, Chris? That's the
sure can. Yeah.
That's the Nikkei going back to 1974. Well, you know, they instituted all of these policies to help their markets. And I mean, my goodness, if you were believing that the government was going to, you know, save the day, you had a 377% return in a 8-year period of time. Unbelievable returns. But yet, once they reached the point of diminishing returns and that stopped, I mean, think back to 1988, 89. I remember the first time I went to Hawaii. Actually won a trip with somebody out there, and they were talking about how Japan had been buying up all the land in Hawaii back in the late 1980s. Of course, somebody was talking yesterday about the fact that there was a period of time where they thought they were buying up all of Los Angeles. You know, they just had these unbelievable amounts of money. But when that turned, right, we know they're keeping interest rates at zero. You know, when the recession occurred, there wasn't a lot that they could do. And here we are 34 years later, in the lost decades that you've had if you were a Japanese citizen who invested into the Nikkei, like most U.S. investors invest into the S&P 500, can you imagine what that retirement's like? There's not been enough time to recover. If you're 60 years old and you were sucked into this, you know, single investment that's the answer for everything going forward, not diversified, if you just blinked, in a matter of 2 years, you're down 50%. And then there was no recovery over that period of time. So that's the risk. There's all kinds of precedent historically. A lot of people think that cannot happen in the United States, but it sure can. I mean, there was a 14-year period from 2000 to 2014 that the S&P 500 went sideways for 14 years with 250% declines, with the government printing all of this massive amount of money that they printed in the intervention. So go ahead, Chris.
Put that back up. Put that chart back up, because even that beautiful cup and handle maybe that they're painting in the Japanese stock market is going to go higher. But right down there in 2012 and 13, that's when the central bank started buying stocks. So that whole rise through that period is artificial.
Yes,
it's not entirely artificial, but it's got some artificial components. You know.
That's when the government steps out to and you know, and what they run the risk of is the government owns everything, right? If you own
then what does that mean?
Yeah, I mean, if you own what is everybody going to be working? Is the government going to step in and take over all the boards? Is that what leads us to the, you'll own nothing and be happy, phrase that we've heard out there. I don't know, but people, obviously they're allowing it to happen through the Bank of Japan as their citizenry because, hey, my asset prices go up. It's supposed to make my life a little bit better, but I'm going to be losing freedom and alternative in the long term.
That's a great chart. All right. So, I was just having this conversation with some people at the FLCCC because I'm helping them redo their strategy and thinking this through. And we're fundamentally in the same business, right? They're talking about where people have lost trust in the healthcare system. And part of that loss of trust is that this is like, I have this conversation with a lot of people now. I'm happy to share it with other folks here. If, unless I am arterially bleeding or having a heart attack, I am never going to a hospital again. My trust has been comprehensively broken because they took people and put them on ventilators and killed them because they got a $39,000 bonus from the government. That's all it took, right? So right. That's a trust breaking moment when you find out somebody will kill you for a few bucks, right? They're like hitmen, right? It's like mob contract hitmen, right? Only with one step removed. So, but let's peel all this back. We have a fiat money system. If I could wave a magic policy wand and fix a lot of stuff, we would have an honest money system come into play. Let the Federal Reserve compete. I get to choose honest bucks, Federal Reserve bucks. And if everybody chooses this over them, they're going to have to manage their product differently. I love competition, but we have a fraudulent money system that leads to all kinds of fraudulent behaviors, not just in healthcare, but everywhere, right?
It does. It does. So, if we were on a gold-based currency, yes, you're going to have periods of inflation and deflation as you have speculation. But it's the closest thing to that debt jubilee that you can get in a modern monetary system. Because if you've got a gold-based system and you get too far out of control, like you did in the late 1920s, then here you're going to reset the other way to come back instead of what we have now, where the powers that be are like, oh, let's just keep printing money. We all know we're going to do it. And then we're just going to take over everything. If you're connected to us, come on, the closer you are to those money centers, the closer you are to the Federal Reserve, the greater your net worth has become. And the more detached they've become from reality. I mean, could you imagine Jerome Powell living on $31,000 a year? I think his outlook would be a little bit different than what it is right now.
Yeah. Yeah. I love, way back in the day, I remember reading that, Warren Buffett said, hey, I've got a solution for this. We just make Congress have to abide by all the laws they pass. So they have to get, there's no federal health care. They have to buy health care, right. Then they'll figure it out, right? They have to live on the average salary. They'll figure it out, right? Right. Yeah, if they vote to go into war, they go first, right? Fine. I love that idea that's fun. You talked about it. We have a lack of consequences, but which leads into the larger umbrella, which is the incentive structures are all wrong. I can show you a passage from one of Will Durant's amazing books talking about Athens about, 200 BC, right? Where they just started debasing their Greek currency. And they ended up, he has a paragraph of how people were behaving that sounds exactly like Wall Street and, all the people who were chasing Bitcoin and it just sounds like today. Exactly. So it's an old thing. When you debase the currency, you shred the culture that's surrounding it because you're encouraging through incentives for people to speculate and scheme and game. But of course, why not? If I can get a 400% return playing the carry trade, why would I do that? Why would I make cars? I'm responsible. I got liability. There's like payroll, suppliers. That's off. That sounds hard. I'll just do a carry trade.
Right. That's right. Play the system. It's financialization. And the worst part about it is when you have those at the top and the closer you are, the more connected you are to the Federal Reserve, how it distorts everything and how the inflationary pressures are coming down to the average individual. And, the average individual is now tempted to compromise their integrity because they feel like they're getting behind. They feel like they have to survive. They've got to protect their own family. So they become so inwardly focused on survival on themselves that the next person becomes their stepping stone to freedom or their stepping stone to a little bit less pressure. So it just feeds down through society to where you have people doing things that they otherwise wouldn't do if you had an honest monetary system.
Right. That is right. Yeah. Now, I'll tell you one effect of all this. So allegedly I have 135,000 followers on Twitter. The worst performing tweets I can put out have tagged at Federal Reserve in them. I had one the other day. It was out for an hour. It had like 6 views, like
Really?
yeah, that is, I'm pretty suppressed over there still, but it's, I think the worst zone of suppression for me is when I beat up on the Federal Reserve, and that carries over to my other tweets. So, I mean, I feel them nudging me, stop doing that, you bad boy.
Yeah.
But yeah, those are the worst performing tweets I get. Either people don't care and I'm making, off topic stuff. But when I look at the view counts, I'm like, oh no, this is actively suppressed.
No, I mean, that's something that I have noticed over the past 60 to 90 days. There was a period of time where Twitter was horrible. And then there was a
Mhm.
period of time where it got a lot better. And then I've noticed here lately, like I've not been seeing yours and anything unless I go directly to look for
Right.
you, Brian Westbury, some of those, another individual that's pretty vocal about speaking out against the Federal Reserve and some of the government action. So there has to be something that's changed here recently to cause that suppression.
I don't know, bringing in a CEO who believes in, freedom of speech, not freedom of reach, who's a WEF clown, Linda Yaccarina. Anyway,
I
whatever.
didn't, I
I'm
didn't
about
know.
to give up on that experiment. But I've
Yeah.
also noticed, and this is important, I've actually noticed that my mental health, I noticed I come away from Twitter disturbed now, and it's a
Mhm.
bothersome thing. And other people at my site have noted it the same thing. So I actually think they've weaponized that AI, like they're just there trying to outright aggrieve me and other people.
Yeah.
I'm not taking it totally personally, not me,
Right.
but maybe, I've got an AI bot that says we know how to make Chris's buttons get pushed in a way that just wears you down, because there's only so much like aggrievement and aggravation and outrage you can sort of support
Right.
in a day. Anyway, so I'm starting to like wean myself off of that. So I now and Dave Fairtex has the same strategy. I know the people I like to follow. I have to go to their feeds directly because they're also not being fed to me. And I have to hand curate that, which means I have to click and go find these people. I can't trust that the system says, hey, I want to follow Paul. When Paul tweets, let me know, right? That would be a clean system, and that would be
Yes.
awesome. That's not Twitter anymore. It's totally corrupt now.
No. And it could have been something great. It could have been an unbelievably good public square, essentially.
Yeah.
Speaking of Dave, I love his weekly market updates.
Oh,
He's
good.
smart,
Yeah,
he's
he's great.
funny, a little sarcasm in there. I mean, I really like what he does. So Dave, kudos to you.
Me too. Yeah, he's awesome. Um, and I don't know if you saw, but we've also had some comment threads that are just so good. Everything I hope for with investing all in this site redesign. And by the way, we have a whole brand new thing that next week sometime. It's just the site. It will be the same, but it's going to look more like Zero Hedge now, in the sense that there's just going to be a chronological front page.
Mhm.
People will I think recognize it. It'll just be easier for people to find stuff. So that's us responding to what people told us. And so if anybody's listening to this and you have more suggestions, we hear them. Let us know, because that's what we're in the business of doing, is we want to make this as easy as possible. Um, but within that, I'm starting it. We're getting these incredibly amazing conversations, Paul, in the forum areas, 100, 200 comments, meaty comments, very thoughtful people arguing over stuff, having different points of view, but it's civil. It just shows what we're capable of when we get the bots out of the story, you know?
Yeah, I for the past week, I've actually started trying to get in there and learn that section of the site. And one thing I've enjoyed is there's a level of respect, even in the debates that's taking place. It's not like, oh, you're wrong. We're trying to figure this out.
Mhm.
Individuals that are courageous enough and honest enough to share their opinion, and others that are going, hey, I kind of disagree with that, or maybe you didn't think about this. I've enjoyed learning. I haven't entered the fray yet, but that's something that I plan to do. I've just got to learn the observe a little bit more so I can really kind of understand where and which ones to move into.
Well, you're speaking for the majority, because we get to see the statistics. Most people still lurk, but we're very encouraging. I want everybody to come in, enter the fray, and so please do. And for
Yeah.
anybody listening to this, please just join in, because we figure this out together. I've got a point of view. Dave's got a point of view. You have a point of view. Everybody listening has a point of view, and none of us have it right anymore. Particularly in a zero trust environment, it might be that I'm still relying on information that is bogus, because you have that expertise or you have a different point of view. Who knows? So we're smarter together, and that's something I believe as an entrepreneur. You do well when you bring in the people who complement you and have skills that you don't have, because if once you get 100 people in a room, Paul, somebody knows the answer to almost any question you have.
within that room, you're exactly right. And if they don't have the exact answer, then the room can figure it out. So I agree with you completely. I mean, we're better together than we are individually. And I think that's why the powers that be spend so much time in suppression in the traditional social media areas, so they can keep us from connecting. Because as
Yep.
we connect and as we figure things out as a group, the more powerful we become, and the easier it is for us to disclose their game of lies.
Agreed. Agreed. Very well said. And we're going to draw it there to a close today, Paul. So we're talking to Paul Kiker of Kiker Wealth Management. If you want to have a free, absolutely no obligation portfolio review or conversation, some of which I hear, Paul, last up to an hour and a half when you talk with people, which
It's
is
a great
wonderful.
conversation.
Thank you for taking time with these wonderful people we've got assembled here. You can go to peakfinancialinvesting.com. The link is down in the below this video here. And so you just click over, everything's disclosed there, and there's a process for getting a hold of Paul and his amazing staff. So thanks again, Paul.
Thank you, Chris. Have a wonderful day. Oh,
All right.
and a fantastic trip.
Oh, I'm so excited.
I'm excited
Please,
for it. Can't wait
I'll
here.
I'll take some time off. You hold the markets together till I get back. Okay.
I'll do my best.
All right.
Thanks, Chris.